Today, we are diving into a really fascinating economic puzzle. Japan's central bank made a huge move, something they thought would make their currency, the yen, stronger. But, plot twist, the exact opposite happened. The yen actually got weaker. So we're going to break down why this happened, what it means, and why it's a pretty big deal for the rest of the world, too. Let's get right into it.
So this is the big question, right? This is the mystery we're trying to solve. I mean, everything in the economics textbooks tells you one thing should happen, but what just went down in Japan was a massive curveball. So how on earth did we get here?
Okay, first things first, let's just set the scene and talk about what actually happened. The Bank of Japan made a decision that was literally decades in the making, and the way the market reacted, well, nobody saw it coming.
So the Bank of Japan, or the BOJ, bumped up its key interest rate to 0.75%. And I know, that might not sound like a huge number, but you have to understand, for Japan, this was a massive deal. It's the highest that rate has been since 1995. The plan was pretty straightforward. Make the Japanese yen more valuable and try to get a handle on rising prices.
Here's how it's supposed to work, according to the textbooks. When a country raises its interest rates, its currency is supposed to get stronger. Why? Because foreign investors want in on those better returns. But yeah, that's not what happened here. Not even close. Instead, the yen just took a nosedive. It dropped from 154 to 157 against the dollar almost overnight. Literally the opposite of what they wanted.
But the yen's weird behavior was really only half the story. The other really big surprise was the global panic that didn't happen. You see, for months, analysts were practically screaming from the rooftops, warning of a financial earthquake if Japan finally raised its rates.
The big fear was something called the yen carry trade unwinding. It sounds complicated, but the idea is simple. For years, big-time investors had this sweet deal. They'd borrow yen at practically zero interest and then invest that money in other countries where they could get much higher returns. So the theory was, if Japan raised its rates, all those investors would panic, pull their money out of global markets, and rush it back to Japan, potentially causing a massive crash.
But nothing happened. The big scary shock, it just never came. Global markets barely even flinched. Actually, some folks in the US market thought it was a good thing, figuring it might even push more Japanese investment their way. So now the puzzle's even weirder. Not only did the yen get weaker, but the predicted global chaos was a total non-event.
All right, so what on earth is going on here? To really understand why the yen weakened when it should have strengthened, we need to look at three really important things happening under the surface in Japan's economy. This is where we start to put the pieces together.
The first clue, it's a big one. It's this number right here, 270%. That is Japan's national debt as a percentage of its entire economy, its GDP. It's one of the highest in the world. And a debt that massive? Well, it creates a very dangerous trap.
It's this weird phenomenon that some people have started calling the Powell conundrum. Here's the deal. In a country that's already drowning in debt, when the central bank raises its main interest rate, the return that investors demand on government bonds can shoot up even faster. And normally higher returns are good, right? But in this case, investors don't see it as a sign of strength. They see it as a flashing red light, a signal that the country is getting riskier and they need to be paid more to take that risk.
So let's just walk through this chain reaction, step by step. The Bank of Japan hikes its rates. Because of that massive debt we just talked about, government bond yields go soaring. Investors see this and think, whoa, holding Japanese assets just got a lot riskier. So what do? They sell the yen and they get out. And all that selling pressure is exactly what made the yen weaker. It's a textbook debt trap.
Okay, clue number 2 is that the Bank of Japan is basically using the wrong tool for the job. You see, the inflation in Japan isn't happening because the economy's booming and everyone's out there spending tons of money. It's what's called cost-push inflation. Prices are going up because things like imports are getting super expensive. But a rate hike, that's a tool designed to cool down an overheating economy by getting people to spend less. Using it now is a recipe for disaster, something called stagflation, where the economy slows down but prices just keep on rising.
And for our third and final clue, we have to look at the Japanese people themselves. Unlike in a lot of other countries, households in Japan save a ton of their money. I mean, just look at this. A savings rate of nearly 7% in Japan compared to around 2% in a neighboring country like South Korea. So when interest rates go up, their immediate reaction isn't to go spend more money. It's to save even more to get those better returns. And that, of course, just slows the economy down even more.
And you know, if all of this is starting to sound eerily familiar, well, it should. To really understand how high the stakes are right now, we have to take a quick look back at a huge mistake from Japan's past. Let's rewind to the early 1990s. Japan was in a really similar spot. The economy was slowing down, but prices were rising. The central bank made a choice. They raised interest rates to fight that inflation. And that single decision is now widely blamed for kicking off Japan's infamous lost decade of economic misery. The parallels to what's happening today are just chilling, and it's why so many people are worried that history is about to repeat itself.
So you might be thinking, okay, this is interesting for Japan, but why does it matter to me? Well, this isn't just a Japanese story. What's happening with the yen sends ripples across the entire global economy, and it holds a really important lesson for other major countries.
So here's the bottom line. The yen is caught between a rock and a hard place. If they raise rates, the yen gets weaker because of the debt. If they don't, inflation could run wild. This instability messes with global trade, and it tends to pull down other currencies in the region, like the South Korean won. But the biggest takeaway is this: Japan is a warning sign. It's a preview of what could happen to any other developed country with a mountain of its own debt.
And that brings us to the big, kind of scary question at the end of all this. Japan has just shown the world that when national debt gets too high, the most powerful weapon in a central bank's arsenal, raising interest rates, can completely backfire. So is this just a unique problem for Japan, or are we watching the old rules of economics break down right before our very eyes?